So there is an option of raising equity as well as debt. So these are businesses. So I'll just take one example. The Mag 7 companies, for example, the companies like Google, Meta, Amazon, Tesla, Apple, all of that companies in this AI boom have been actually issuing massive amounts of paper or massive amounts of debt.
Anyone can buy a stock. Few know which ones to buy, and even fewer know at what price to buy them at. I've been part of that process at Moat, and today I intend to pull back the curtain on it. At Moat, we manage our clients' funds through 5 different approaches: moderate compounders, emerging Moat, special opportunities fund, happiness portfolio, and a fixed income option. And today I have with me Mr. Mithun Joe James, the CIO of Moat Financial Services, to talk more about what actually goes behind building them. And before we start, let us discuss about the investment philosophy of Moat and the offerings.
The investment philosophy of Moat is focused on basically 2 things, which is protecting the client's capital as well as identifying businesses which are emerging, as in businesses which are in the cusp of becoming really big, getting large, sustainable moat in their growth journey. So what we essentially do is that we try to identify businesses with substantial growth, which are in sectors where there is massive tailwinds, which are managed by smart, shareholder-friendly, ethical management, where the incidence of debt and leverage is at a minimum, and these businesses need to be available at a reasonable valuation. We are not saying it has to be really cheap, but those businesses has to be at a fair value to their intrinsic value. So like Ben discussed, we have 5 different offerings for clients. These are for people with different risk profiles and different requirements in their investment journey. So we have one called as moderate compounders, where the mandate is to protect the client's capital, where what we do is we have a healthy combination of blue chip businesses and businesses which are high growth, which may not be essentially blue chip today, but they can become really big tomorrow. Second, we have something called as emerging Moat. These are businesses where there is a lot of growth. Maybe the return on capital may not be as big as the first cohort, but these are companies which are participating in India's growth journey. 3, we have something called a special opportunities portfolio or special opportunities fund. So in this, what we look at is we try to identify businesses which can take part in India's growth journey to become a developed economy by 2047. Then we have something called as happiness portfolio. In happiness portfolio, we identify businesses based on the Sharia principles, where these businesses adhere to the ethical principles envisaged by Sharia laws. And so the 5th one is basically for a set of clients who wants fixed returns to their investment. So that is a set of fixed income portfolios. So basically these are the 5 different mandates we have, or the 5 different portfolio approaches we have.
Could you please tell us what kind of investors are suitable for the fixed income options?
Sure. So there are actually 2 broad categories of investors who would want the fixed income options. So one is a certain kind of investor who does not want the volatility which is associated with equity-based portfolios. They cannot stomach the ups and downs of equities. So, and they also want capital protection plus a fixed return. So that is one category of investors. Second is there is a set of investors, most probably these are corporates or MSMEs, who by their mandate wants debt to be part of their portfolio, or they are by mandate not allowed to invest in equities beyond a point. Then there is a subset of this, which is clients who want some amount of diversification into fixed income. So these are basically the 2 different cohorts of investors who would want debt products or fixed income products, which is an accurate description. Yeah.
Okay. Could you also add some color on the relevance of these products in today's market?
So if you look at globally, debt, for example, debt markets are much bigger than equity markets. The reason is because if you take an example, the government would want funds for development. So they would sort of launch a lot of sovereign-backed government securities and bonds. There are overnight funds. There are other large great companies who wants to raise capital, so there is an option of raising equity as well as debt. So these are businesses. So I'll just take one example. The mag 7 companies, for example, the companies like Google, Meta, Amazon, Tesla, Apple, all of that companies in this AI boom have been actually issuing massive amounts of paper or massive amounts of debt, and these are all AAA rated debt instruments where you have a high rate of protection of their capital. So most of the clients, like we explained in the first answer, there are a lot of corporates as well as retail customers who want an exposure to this debt. And the kind of government securities that we discussed, these are all backed by the sovereign. So meaning there is no delinquency risk for that product per se, and you get a good return. And if you ask me, you also need to have a sufficient diversification between a fixed deposit, which is the other option, right? So you actually need to get some amount of exposure to the government securities, some amount of exposure to the debt instruments, along with your fixed deposits. So that I think is the relevance of a fixed income product.
What value additions do you bring to the table with these products?
If you look at it, there are about 16 debt mutual funds itself in the market. Right, so for a novice investor or a normal investor, it may not be within their capability or wherewithal to identify which is the best or which is suited for them. So that is where a fund manager like us or a PMS like us comes into the picture. So we have a dedicated research team who can identify these businesses, who can do in-depth research, and there is also a portfolio approach which is required. So it is not like a one size fits all attitude. So where you pick up one from here and one from there. So finally what happens is that at the end of the day, you will have a potpourri of several funds which may not be a good fit for your investment requirement or your risk appetite. So as portfolio managers, what we do is we identify the best lot from the different options available through our dedicated research, and number two, we bring in a portfolio approach to it.
In this product, do you have any options for a client who looks for a regular income and at the same time expects a decent capital appreciation?
We have certain products which are not known by many clients per se or many retail investors per se. These are, one example of this is called REIT. REIT is an abbreviation for Real Estate Investment Trust. So imagine all of us at some point in time would have always thought that we would want it would be very nice if we had a property in Bangalore, for example, or Hyderabad, for example, which is rented out to a software company, and you get good returns in terms of rent, and the capital would appreciate, capital or your investment would appreciate because the real estate will also appreciate. But what holds us back is that one is that is an unknown land, you are not there, number one. Number two, there are legal hassles. Number three, you have to go and collect and there can be issues. So there are multiple things which holds us back. And third is the liquidity aspect. So tomorrow if you want that funds to be plowed back, it's not easy because it's a hard asset. So the REIT, which I'm explaining now, is an app product which brings the best of both worlds. So what it does is that it gives you an opportunity to become a part of a real estate property. You can enjoy the cash flows from that real estate property, but it is managed by a professional manager and it has got sufficient liquidity. Meaning tomorrow if you want to liquidate a portion of it or fully, you can do it in the exchange. So that is something called as REIT. It is Real Estate Investment Trust. There is another product which is known as InvIT. InvIT is Infrastructure Investment Trust. So if you want a portion of the booming power grid, so you can buy a portion of that power grid and get a fixed return from that portion. And In both these products, you can also get a capital appreciation. It is traded in the exchange, so there is an opportunity to get a capital appreciation from that. Second option, other than REITs and InvITs, is you can also invest in dividend paying stocks. So that may not be an exact fixed income product per se, but there are certain companies in India which have got a history of consistent, strong dividend payments. And along with that, we see that the capital appreciation also.
So before wrapping up, could you also help us with some live examples of the dividend yield stocks?
Dividend yield stocks by nature is part of a client portfolio specifically for that reason. That is, you want the recurring dividends to come. So you want to get a portion of the company's profit as dividend every now and then. And like I mentioned earlier, there are several companies in India who has got a fabulous track record of paying dividends to the clients. So one example could be a public sector company called Coal India. So in the case of Coal India, what they do is that they have an average dividend payout of about 6%. So we know that our FD rates in India is somewhere close to that number, right? It's about 5%, 5.5%, 6% if you invest for slightly longer term. So this company pays you about 6% plus dividends. And I was just looking at the data the other day. In 3 years, their stock price has given you about 23% CAGR. Meaning, if you had invested 1 lakh, in 3 years that would have generated a return of about, that capital would have become about 1.8 lakhs. On top of that, every year you have received about 6% dividend on your investment. So that's a fabulous example. It may not be there in every period, but over a long period, I think you can get a capital appreciation also. So another example that I can put up is a company called Hindustan Zinc. So Hindustan Zinc again has got a history of paying about 4 to 5% dividend based on the share price. And they have a 3-year CAGR of about 18%. Even your REITs and InvITs, for example, what we discussed, have also a history of capital appreciation. There is a REIT called IndiGrid InvIT. It's an invite instead of a REIT, it's an InvIT. So IndiGrid InvIT gives you about 8-9% of yield, as in sort of dividends they pay about 8-9%. And that stock has also given you a return of about 13%. So combined you get about 21-22% of returns. So these are some examples of fixed income securities or quasi-fixed income securities which can actually give you a fixed dividend kind or a fixed quarterly or annually or semi-annually returns, and they give you a capital appreciation.
So thank you for sharing your insights about the fixed income options that Moat is offering. If you have any more questions, please don't hesitate to send a message on the contact details in the description.